Welcome back, everyone. It's been a while since I've said anything on here, and that's mainly because the way I view my portfolio right now, what I've said recently, it kind of still stands. I am happily sitting on my portfolio because I think it's the right allocation for me. That said, today, the topic for this video is 5 stocks for the next 5 years. So that is 5 stocks that I would buy today and hold for the next 5 years if the market closed now and only opened back in 5 years. So originally when I was structuring this, it was 3 ideas and then I kind of had one alternative and then had another alternative. So there's 3 main ideas and then 2 alternatives, which is 5. So before people start asking, well, why is there none of this? Why is there none of this in this? Just so I'm clear, this is stuff that has to be held for 5 years in this scenario. That's why I'm skeptical on some of them. But anyway, it has to be held for 5 years means I need to avoid things that are too heavily price dependent. So things that are too cyclical might not get included here, even if I think they're very good for a few years. What type of stock would do well in this scenario? Well, value is mean reverting, so sometimes things will be expensive, sometimes they'll be cheap, but in the end, I need to have a value basis here. But really, I probably need growth as well because in order to get the right returns over the longer term, you need to have the company actually be worth more in the future. And in order to have a better shot at that, you need to have, well, the company make more money in the future because there's plenty of ways to find value today, and some might resurface as, oh, well, this was actually worth more. But unless they actually prove to be worth more and more, well, then you're not going to get the greater returns longer term. Anyway, so in this video, 5 names, I will track a separate equal weighted portfolio of them versus SPY and HXT, HXT being the total return Canadian index ETF. Why that? Well, because all of these companies are Canada focused, or Canada listed at least. Disclosure, again, and pretty obvious for most of the names, I own all of the names discussed today. Some are larger positions, others are smaller positions. None of this is investment advice. I really want to speak more thematically about the stocks here because you'll notice a few times where I probably avoid giving some my thoughts and projections on specific numbers because I want people to make their own assumptions. I like these for certain reasons. I have rough ideas at numbers, but predicting the future is beyond my ability, maybe within some of your ability. But anyway, you need to make your own assumptions with the different stocks, and I don't want to overhype them. So with that, let's get to number 1. So the first stock is Dream Unlimited, and I've spoken about it a few times in the past, and I think this is the perfect example for this type of scenario of 5 stocks to buy and hold for 5 years. Plus, in this case, I hope. Why is this? Well, when I look at what I was paying when I started buying, the market cap was just over $1 billion. $1.05, something like that. And the stock price was $22. Well, now it's 25, so some people might think, oh, we missed it. In my opinion, not at all, because if you look at what has happened in the meantime, the company has added value. Why? Well, they've bought back shares trading at a discount to book value. They've grown the asset management business, and they own a larger stake in some of their assets. And, if you get to later in the year, they're going to probably renew the buyback. their assets are going to renew the buyback, so they're going to own a bigger and bigger stake in some of their existing asset management undervalued businesses. Meanwhile, they are closer to growth, high quality business in good locations, and it gets cheaper by the day. So while I still believe the price is undervalued, I think the more important aspect in this case is that, look what happened. We're a few months later, stock price went from 22s to 25s, and well, it's not really any more expensive than where it was a few months ago. And so overall, this business really fits well into the part of my strategy that is buy and forget. And I referred to it a bit as a neo barbell, and that's because if you look at the barbell strategy, it's have most of portfolio in bonds and then take risks around the edges, and so that kind of protects. The neo barbell that I refer to is having having the barbell instead of bonds, having high quality equities in safe industries, and then having from that, then you can play around at the edges with some high risk positions. But I really like this industry in general, real estate development. It's a good business, historically has been, probably will continue in the future. Fits well with my mentality, and this stock is a good way to be at the center, at the core of that, because like I said, it gets cheaper by the day, assuming the price is flat. So, I don't really stress out about the price day to day, because I believe that if you look out a few years, the company will be worth significantly more. And not having stress is a very underrated part of positions. Stock number 2 is Linamar. And I know what some of you are probably thinking. Okay, it was good in the 30s. Okay, it was good in the 40s. But is it really still a buy in the 70s? And in my opinion, yes, it remains very inexpensive. Every expectation that I have had for this company in the past few years at least, it is surpassed. And, if you look at what's the multiple that it's trading at now, it's not really that expensive. If you look at EV to EBITDA, 3.5, maybe 5 times if you want to think that the near quarters, they really struggle. And to me, there's still parts of the business that are not firing on all cylinders. And honestly, this is a company that spends a lot in terms of growth CapEx and has high quality machinery that can be adapted to the future. And so I really don't know why the market is that skeptical about the company, especially if you look at the longer term growth track record of the company. I think it's one of great quality. And I think really the quality of the company really only shines through when you look at, take the worst quarter, take Q2 of 2020. What were the results there? In one of the worst quarters in recent, if not medium to longer term history. Well, if you take that and you annualize that quarter, they made 92 million. So the current price, EV to EBITDA, at assuming that quarter, 4 quarters in a year, would be 13. 13 annualized depth of the pandemic. That's not crazy expensive to me, and that's assuming a very, very bad scenario. They're making multiples of that right now and growing, and virtually no debt anymore, which they did have then. And it's been a great company longer term. Look, I'm not going to sit here and tell you that Q2 is going to be excellent. That's what the market is saying. It's not going to be excellent. Why? Well, because of semiconductor issues and all that stuff. And that's fine because I'm not holding the company because of Q2. And maybe there's some bad news that comes out, but okay, well then let's look at the next 12 months. What then? I'm guessing that it will be better. And if it isn't, well, really, so what? Look at the cash generation at these levels, at slightly lower levels, and the market really doesn't have much in terms of expectation. And look, I completely understand what some people might say in that, well, you don't want to buy a company when the earnings potential is kind of realized. And, their earnings now are closer to top of cycle levels than bottom of cycle levels. And I understand that. But I also understand that if you're saying that, okay, well, top of cycle means multiple contraction, well, lower in cycle would mean multiple expansion by that logic too. And I prefer not to get into that debate of how much should multiples contract or expand. But I also think that we are not at peak cycle levels. And when you look at what this level means in terms of this multiple, and the fact that if you look at over the long term, I expect earnings to be higher in the future, well, then we're really arguing over a few percent over the next few months, where longer term, the question is more so growth. And longer term, I really don't think, if you look at peers, the multiple on Linamar is lower than peers in the same industry. So, I really think that it doesn't make much sense. Multiple should be higher, but that's not my case here. My case here is that over the longer term, they will have an impressive track record of growth, organic and inorganic, and growing into new and legacy markets. And I think that will continue. And I know it's not flashy, the type of industry that it's in, just kind of boring and kind of grinds along. But I think that they can be effective in flat markets. They don't need booming economy type conditions to grow, as they are able to access new markets and grow in flat markets by content per vehicle and stuff like that. So they're able to grow by acquisition organically and have tons of balance sheet room and capital to do it. I think they're in a strong position. Is today the single best day to buy it in the next 5 years? No idea. Can there be another down cycle that can take it down a significant percent? Well, it already is down a decent percent off the highs. Can it go lower? Absolutely. But again, looking out 5 years, I think there's a decent shot that it won't matter much at this entry point where the cycle is approximately. So last of the main three is Verde Agritech. And yes, still on about this one. Why? Well, the market may be completely out to lunch on this one. Why do I say that? When I look at what might happen with the company, there's a very wide array of outcomes. And look, there's 100 ways that they can fail to meet their ultimate goal. But honestly, in most of those, it's still undervalued, and in many of them, significantly. And look, I run a whole bunch of different scenarios on different companies. I kind of think about, okay, well, where would they be if this happened? Where would they be if this happened? And in this case, the amount of negative assumptions that I need to make to argue this is fairly valued is pretty impressive. And, I use in looking at those assumptions, my base case that I use, it by the way is far more bearish than the current market. It's a very bullish. I'm very bullish on the opportunity. My bull case, well, it's closer to a YOLO type situation. So why do I still really like it? I think it's cheap at today's prices. And if you're bullish commodities, then it's really cheap because I kind of don't assume these prices will last forever. And the scale of, well, how cheap? For context, when it was approximately twice the price, I didn't sell any. And now the commodity prices are significantly higher than where they were when the stock was twice the price. So commodity side is doing well. The growth rate is pretty impressive. And so, like I said, I can assume that prices fall significantly, and it could be well more than made up for with the growth, because I don't think the market is factoring in much, if any, of the high commodity prices as any forward-looking expectations to that effect. Now, that's just me looking at the price and kind of looking at, well, you know, what might be fair value if prices were different levels. I also think the market is factoring in absolutely zero of potentially significant ESG impact. A lot of people seem to think that ESG would make something expensive, and really looking around, some cases yes, other cases it looks like the market does not care about ESG, but you know, some people do, some people hate it, some people whatever. I just think there's zero factored in this case. Next, you know, I said earlier in the video, I don't really have much commodity related. Why is this commodity related stock in the video? Well, costs are extremely low, meaning bottom of cycle, it's still making money. And hopefully, you know, we talked before about multiple expansion. I believe it would deserve that at the bottom of the cycle, and, you know, multiple contraction at the top. Maybe that's what we're seeing to a very significant degree, maybe not. And so costs being low allow the growth aspect of this company to be the main driver going forward. Lastly, I think scale is immensely, well, doubly important here. Why? Well, on one hand, scale gets you more sales, which is good, especially in a bulk company whose main growth is being able to sell a lot more than they can now. But also, in this case, scale kind of lends to credibility of the product. It shows that not only others are using it, but many people think it's a good and effective replacement, which means that more might be likely to try it. And this is kind of a spiral where once you achieve a certain amount of scale, once you achieve the credibility, once there's a lot of people that think, okay, this product is good, well, then the risk of failure in that regard decreases because there's more validation of the product. So all in all, there's a lot that needs to go very poorly in order for this to be either expensive today or overvalued today or fairly valued today. You need a lot to go wrong to permanently lose money, lose value here, versus the potential, which is, in my opinion, significantly higher than where the share price is today. So the first dark horse idea is Melcor Developments. This is one that may be dead money, which, by the way, I'm convinced is how all great investment pitches begin. Maybe dead money, but there's also a non-zero, non-negligible chance that this one proves to be really good. And let me explain why. What you're getting with Melcor is a lot of leverage to a lot of relative value sectors. Because for me, the bottom line on this one is it seems to be pricing Alberta like it's toast. And really, I think that's a function of oil. Now, I'm not at this point super bullish on oil, but I also don't think it's going anywhere. And so here, the market is basically saying, yeah, Alberta, who cares? It sucks. And I think there's a decent shot that at some point Alberta will recover and then the company might look a whole lot better. Because if Alberta does stage some sort of recovery and shake off the negative sentiment, you have leverage to probably one of the cheapest, if not the cheapest, real estate in Canada, in one of the strongest economies globally. And on the home builder side, you get more impact from marginal growth. And on the land side, you get the benefit of the possible inflation that might come in a stronger economy. And the growth in value associated with developing into a stronger economy. Because if you think about the history of this is a company that when times were okay and then good, they 100-bagged their dividend. It went from 1 cent a share to $1 a share. And while it's well off the $1 a share now, it also has been keeping / growing the book slightly in a market that has been a absolute disaster. So what if the market is finished being an absolute disaster and the market can get back to the economy, the local economy can get back to growth? Well, there's no reason that this should be a bad company. It's a very solid business and has big margins and basically has been suffering from their book declining. Their existing book has been declining because Alberta has not been the great place to invest starting 7 years ago. There was a lot of expectations in Alberta, a lot of expectations in this company. There were. Now, not so much. And so, if they only sucked because of the Alberta, lots of troubles in Alberta, well, okay, let's say that's over. Will they still be a company that deserves to trade at half of their book because they can't grow? Well, no, because they might actually be able to grow. And their book might actually gain value instead of losing value. And it's a dynamic like this that I think has the opportunity, if it proves out, to turn this company from one that market can basically agree, yeah, it sucks, but who cares? Or, yeah, it's slightly cheap, but who cares? To, wow, this is actually a good company with good growth. And the difference between those two is would be proved out in valuation. Will it happen? I don't know. If it does happen, could there be a significant amount of upside? Well, it's not a huge company already for the sector that it is and the growth that it has proved out in the past. So it could do significantly better than a company that trades at half book. The fifth stock is a bit of a different one and one I haven't discussed here in the past. So I describe this one as an alternative because I'm not sure if it deserves a place here yet. I think there's a number of things lining up that make me think that it might, and I think mainly that the valuation has come down enough that I'm willing to put it here because I don't know if their platform product will be adopted. But from my understanding of Voxter Analytics and what some of the different things that they're planning on or working on offering, I feel like a number of them have a number of benefits that seem like they should be more widely adopted. Now, because we don't know how much success it'll have, that's why I don't know if it deserves a place here yet. But if it, so the question becomes, why did I include it here? Well, if we assume that foreclosures will at some point in the future be legal again, I think the valuation of the company based on past business and based on the returning of that particular tail hedge, the valuation isn't crazy. And then you look from there, okay, well, defending downside, let's say the valuation could still come in a bit if everything else fails. But what if everything else doesn't fail? Well, then you look and you have a company that has a number of irons in the fire or projects under development or whatever you want to call it, where there's a number of different avenues which each could provide sufficient growth to make the current stock look quite inexpensive. Will all of them succeed? Probably not all of them to their fullest potential. Will some of them succeed? Maybe. And so recommend looking at the company, looking at their offerings, and thinking about if they provide a lot of value. And I think a number of them do. And so if they can capture a market, I think there is a significant amount of runway. But again, it's fairly early to see if they're going to have as much success as they could or may have. And so that's why I thought it was a bit early to have this here, but I do think hopefully, again in this scenario, hopefully in the next 5 years they can kind of prove out what one or multiple of their offerings, and that would make the company at today's price look inexpensive if they're able to do that, but it is an if. And as a summary, here are the 5 names that I would buy today and think will beat the market over the next 5 years. Some are riskier than others. It's always possible that 1 or 2 will fail. That's why I don't give investment advice. Hopefully they don't. Hopefully they all succeed. And yeah, so Dream Unlimited, Melco Development, where you really the thinking is, what if their struggles are more a function of the landscape falling apart around them than their fault, and what happens if that turns around? What happens if the struggles are over? What happens if it's actually a half-decent company? And Linamar, growth story, trading like a very value stock. Verde, really run the numbers would be my recommendation. Plug in some numbers, punch it into a calculator, have some ideas, different scenarios, have a look. Voxter Analytics, where that one I will add to the model portfolio, today's price, because buying recently. And I will track them versus the S&P 500 and the Canadian Total Return Index and see in 5 years. Hopefully someone will remind me, or I will remind myself to post an update in 5 years. It's a little ways off, but we'll see. Thanks for watching, everyone. I didn't really want to drill into significantly more detail than this in today's video. This is more of an idea generation, 5 companies that I would buy today that I think have a good shot of beating the market and having pretty good returns over the next 5 years if I had to hold them for 5+ years. What I'm very interested in, however, is what's your best idea under the scenarios that I scenario that I described. Have to hold for 5+ years. Best idea. Going to beat the market. Not purely risk. And yeah, with that, I wish everyone the best day and hope to see your answers in the comments. And until then, all the best.